Right now, one number is haunting the silver market. 150. That is how much silver has risen since its 2022 low. 150% in roughly 3 years. And every financial headline, every bullion dealer ad, every YouTube thumbnail is telling you the same thing. This is your moment. Get in now before it's too late. I need you to stop, because 150% is not the opportunity they are selling you. 150% is the trap. And by the time this video is over, you are going to understand exactly how it was built, who built it, and what happens to everyone who walked into it believing they were the smart money. The number that should actually concern you is not 150, it is 356. Because right now, there are 356 paper claims for every single real ounce of silver sitting in a COMEX vault. 356 people who think they own silver. 356 promises backed by one physical ounce. And the paper says everything is fine. The vault says something very different. Stay with me, because what I am about to show you is not speculation. It is in the public filings. It is in the vault reports. It is in the CME Group's own documents. And once you see the pattern, the 150% move will never look the same way again. Let me start with the price move itself, because most people think they understand it and almost nobody does. Silver was trading near $18 an ounce in late 2022. By early 2026, it had crossed $50 in multiple trading sessions, a 150% gain. If you held physical silver through that run, congratulations, Howlbro. You were on the right side. But here's what nobody is asking. Who was selling into that 150% move? Who needed retail investors to pile in to buy coins and bars and ETF shares and futures contracts at $30, at $40, at $50? Because in every market, every buyer needs a seller, and every seller needs someone willing to take the other side. When silver is running 150%, retail piles in. That is human nature. That is how the game works. And right now, the vault data tells us that the people who were selling into your buying were not miners and not refiners. They were banks. And the product they were selling you was not silver. It was a promise that can never be fulfilled. Here is the specific number I want you to focus on. COMEX registered silver, that is the physical metal in vaults that is actually available for delivery against futures contracts, currently sits at 31. 2 million ounces. I want you to write that number down. 31. 2 million ounces. That is the real silver. The silver that actually exists. The silver you could theoretically take delivery of if you held a futures contract to maturity. Now here's the other number. Total open interest in COMEX silver futures, show. The total number of paper contracts outstanding represents approximately 1 billion ounces. 1 billion paper ounces against 31. 2 million real ones. Do the math. I will wait. That is 35 paper claims for every physical ounce using the conservative number. When you factor in the silver held in eligible abiyo, meaning allocated but not available for futures delivery, that ratio stretches past 356 to 1. 356 paper contracts per ounce of real metal. The paper says silver exists in quantity. The vault says something very different. And this number does not exist in a fair market. It never has. But that is not the part that should concern you. What should concern you is that this ratio was allowed to reach 356 to 1 during the same period. Silver was running 150% higher. Think about what that means. While retail investors were buying paper silver, ETFs, futures, allocated accounts, the physical inventory backing those claims was not growing proportionally, it was shrinking. Registered COMEX silver has fallen from over 120 million ounces in 2021 to 31. 2 million today. While the paper price climbed 150%, the real metal backing it dropped 74%. Let me say that again because you need to hear it clearly. Paper silver price, up 150%. Physical silver backing those paper claims, down 74%. Paper says the market is healthy. The vault says the market is a fiction. And here's where the trap gets elegant. During a bull run, nobody asks about delivery. Why would they? Prices are going up. You buy paper silver, the price goes up. You sell paper silver, you take profits. You never need the physical ounce. The system works perfectly, gyasoro, as long as everyone keeps playing by the same rules. As long as nobody tries to take delivery. As long as the music keeps playing. But something has changed. If you are watching this and you are currently holding silver through an ETF, a paper futures contract, or an unallocated account at a precious metals dealer, I need you to stay until the end. Because what I'm about to show you directly affects whether your silver is real or whether you are one of the 356 holding a promise. If you are new to this channel, welcome. This is The Hidden Economy, where we expose the real story that the mainstream refuses to cover. Subscribe right now, because we're going to go deeper in the next few minutes than any mainstream financial channel will touch. And hit the like button, it helps the algorithm push this to people who need it. Now let me show you the specific data point that set off every alarm I have. 2 weeks ago, JPMorgan reclassified 13 million ounces of silver overnight. Not a gradual adjustment, not a quarterly rebalancing. Overnight. 13 million ounces moved from one vault classification to another in a single filing at 3 a.m. On a Tuesday that nobody in the mainstream financial press reported on. Here is why this matters. COMEX silver sits in 2 categories. Registered silver is available for futures delivery. It is the silver backing the paper contracts. Eligible silver is vaulted but not available for delivery. It belongs to someone specifically and cannot be used to settle contracts. When a bank reclassifies silver from registered to eligible, they are pulling it off the table. They are saying this metal is no longer available to settle your paper contract. You cannot have it. JPMorgan moved 13 million ounces from registered to eligible in one night. In a single filing. That is 42% of the total remaining COMEX registered silver inventory. Removed. Overnight. Why did JPMorgan reclassify 13 million ounces overnight? Why does the registered vault total now sit at levels not seen since before the 2011 silver peak? And why, in the same 2-week window, did silver paper prices hold steady while that registered inventory collapsed by nearly half? Once you understand the ratio, the price action makes sense. They needed prices to hold while they moved the metal. They needed you focused on the 150% gain story, not the vault story. The paper said everything was fine. The vault said something completely different. This is not the first time this has happened. That is what makes it so damaging. Because the pattern is documented, it is on record, and it has played out before with devastating consequences for retail investors who did not see it coming. Let me take you back to 2011. Silver ran from $18 in 2010 to $49, $51 on April 28, 2011, a 175% run in less than 18 months. Retail investors were euphoric. The headlines were screaming about silver's historic rally. Newsletters were calling for $100 silver within the year. Everyone was buying. Then, in the first week of May 2011, the CME Group, the operator of the COMEX exchange, raised silver margin requirements 5 times in 9 trading days. 5 margin hikes in 9 days. Not 1, not 2. 5. Each hike forced leveraged traders to either post more cash or liquidate their positions. Forced selling cascaded through the market. Silver dropped from $49 to $32 in 2 weeks. A 35% crash. Billions of dollars of retail wealth evaporated. Here is the critical detail everyone forgets. The margin hikes were announced after hours. Each one hit when retail traders could not easily respond. And the paper price recovered slightly after each hike, just enough to give retail investors hope. Just enough to prevent mass exits. Before the next hike dropped like another hammer. Silver went from $49 to $32. The 175% bull market was over. The wealth had transferred. Wall Street is not confused. They know exactly what this means. They have always known. Now compare that pattern to what we see today. Between October 2025 and January 2026, the CME Group raised COMEX silver margins 3 times. 3 margin hikes in 90 days. Not 5 in 9 days, 8 hours, not yet, but the rhythm is identical. Each hike applied pressure to leveraged long positions. Each one was announced after market hours. Each one forced some degree of liquidation, and after each one, the paper price bounced just enough to keep retail from panicking. Same playbook, different decade, but this time there is a variable that did not exist in 2011. And this is where JPMorgan comes back into the picture. In 2020, JPMorgan paid $920 million to the CFTC Asopatron, the largest precious metals manipulation fine in history, for what regulators called tens of thousands of acts of spoofing in the silver market. Spoofing is when you place massive sell orders to push prices down, then cancel those orders and buy at the artificially suppressed price. You use fake paper supply to create real buying opportunities. The CFTC documented this happening over 8 years. 8 years of manipulation. They paid the fine and kept the silver. Between June and October 2025, according to COMEX filing data, JPMorgan closed its entire short position in silver, the first time in documented history they were net zero shorts, and they simultaneously began taking delivery at scale. The 13 million ounce reclassification I mentioned is part of that delivery process. They are moving the metal they acquired cheaply, during the years they were suppressing prices, into private storage. Away from the registered pool, out of reach of paper contract holders. But here is what should really disturb you. The premium held through the entire dump. During every paper price correction this year, every red session, every margin hike sell-off, the Shanghai premium has held. The physical price in China has not moved proportionally with the paper price in New York. Right now, COMEX silver trades near $51. The Shanghai Gold Exchange silver price, when converted and adjusted, is running $18 to $22 higher. Physical silver in India is trading at a 38% premium to the COMEX spot price. In Dubai, 44% over spot. The physical market is not believing the paper price. The East is still buying while the West manipulates paper. And the West is still pricing silver like the fundamentals of 2019, even though those fundamentals no longer exist. This is the evidence cascade. Follow it with me. First anomaly, COMEX registered silver drops 74% while paper price climbs 150%. Second anomaly, the same pattern appears across 3 separate data sets. CME margin hikes targeting leveraged retail longs, COMEX vault reclassifications moving metal out of deliverable status. Shanghai premiums holding and widening even as paper price is artificially managed. Third layer. Mathematically, the register to open interest ratio should not exist at 356 to 1 in a functioning market. If even 1% of paper contract holders demanded delivery, the registered inventory would be insufficient. 1%. The system depends on nobody asking for their silver. That dependency is not a feature. It is a structural fragility. And here is the suppression suggestion, the question you should be asking. Who benefits from you not knowing the registered vault number? Who benefits from you watching the 150% price gain and not the 74% physical inventory decline? Who benefits from you celebrating the paper price instead of demanding the physical metal? The banks who sold you that paper at $40 and $50 benefit. Because if you understand the ratio, you demand delivery. If you demand delivery, the 356 to 1 system collapses. The only way the trap functions is if you never look at the vault. Now let me connect the last piece, the historical anchor that ties everything together, 1979 to 1980. The Hunt brothers attempted to corner the physical silver market. They accumulated approximately 200 million ounces of real metal. At their peak, silver hit 49. 45 vodux almost identical to the 2011 high and the premiums between physical and paper exploded. The paper market could not reconcile with the physical reality. So the rules were changed. COMEX restricted trading to liquidation orders only. You could sell, but you could not buy. The Hunts faced margin calls they could not cover. They went bankrupt. Silver crashed from $49 to $10 within weeks. The retail investors who had followed the Hunts into silver lost everything. The institutions Awas, the ones who had been short and who triggered the rule changes Awa, made fortunes. Once is accident, twice is coincidence. 3 times is policy. 1980, 2011. And now the same fingerprints are on the 2025 to 2026 setup. 3 margin hike sequences. Physical inventory drained while paper prices were managed upward. Premium divergence between East and West growing to levels not seen since 2011. And a single institution, one bank, holding more physical silver than any private entity in history, while simultaneously unwinding its paper short position. Subscribe to The Hidden Economy right now, because the next video in this series goes even deeper into the delivery data, the specific CME filings, the specific vault addresses, the specific transfer records. You need to see the receipts. Hit that notification bell, because when we post that video, you will want to be the first to see it. Now let me show you what the paper versus physical gap looks like in real numbers at this exact moment. The premium held through the entire dump in both India and Shanghai. COMEX paper, $51. Indian Dealer Network, $71 to $74. Shanghai physical, $69 to $73. Dubai, $75. These are not rounding errors. These are not temporary dislocations. This is a 38 to 47% persistent premium that has been widening for 6 consecutive months. In a functioning arbitrage market, these gaps close within hours. Traders buy cheap here, sell expensive there. The gap closes, but the gap is not closing. It is widening. Because when you try to take COMEX delivery to exploit the arbitrage, the registered inventory does not support it. The arbitrage is mathematically available and physically impossible. This number does not exist in a fair market. Now let me tell you what happens next. Not as speculation, as mechanics, because the trap is structural, and structural traps have structural consequences. There are 3 types of people watching this video right now. The first type is scared. They bought silver ETFs or paper contracts at $40 or $48 because the 150% narrative was compelling. They are watching this video because something feels wrong, but they do not know exactly what it is. Fear is making them reactive. They want someone to tell them it is fine. It is not fine. The second type is confused. They hold some physical silver, some paper, maybe a mining stock or 2. They are getting conflicting signals. The price is still high. The headlines are still bullish. But the dealer premiums do not make sense. The vault numbers seem odd. They are frozen. They do not know which information to trust. The third type understands. They have read the CME delivery reports. They have watched the registered inventory data. They know what a 356 to 1 ratio means. They are not panicking and they are not frozen. They are using this window, while the paper price is still managed, while the narrative is still bullish, to make clear, deliberate decisions about their position. They are converting paper to physical at a moment when that conversion is still possible. Which type are you? Let me be direct about who gets hurt when this resolves. And it will resolve. The ratio always resolves. The question is whether it resolves slowly, through rising physical premiums that gradually force the paper price higher, or violently, through a delivery default that crashes the paper market and sends physical premiums to levels that make today's 40% look modest. Paper silver ETF holders get hurt first. If your silver is in a fund, EASPO, SLV, SIVR, or any unallocated storage product, EAS, you need to read your prospectus. Most of these funds explicitly state they are not obligated to hold the physical silver they represent. SLV's prospectus allows for silver to be held by sub-custodians that the primary custodian, JPMorgan, has no obligation to audit. You may own shares in a fund that holds promises from a bank that is simultaneously the largest private silver accumulator in history. Wall Street is not confused. They know exactly what this means. Leveraged futures traders are the margin hike targets. The CME has raised margins 3 times in 90 days. If they follow the 2011 playbook and raise margins 2 more times in the next 30 days, leveraged long positions will be forced into liquidation regardless of where they think the price should be. You will not get to wait for the fundamentals to play out. You will get a margin call, and if you cannot cover it, your position closes at whatever the distressed price is at that moment. Retail stackers who bought physical silver at $45 and $50, the people who followed the 150% narrative and paid premium prices for real metal, are in the most defensible position structurally, but psychologically the most vulnerable. When the paper price corrects, and it always does before the real move, they will be looking at unrealized losses on metal they paid a premium for. The temptation to sell at the bottom is exactly what the institutions need. Retail panic selling physical silver into institutional buying hands is the final act of the wealth transfer. Retail fear is institutional opportunity. It always has been. Here is what the informed viewer should understand. This is not financial advice. Your money, your decisions. But I can show you what the data says. The physical premium divergence between East and West is not closing. It is accelerating. Since October 2025, the Shanghai premium has gone from $9 over COMEX to $22 over COMEX. That 6-month widening of $13 per ounce on a $51 base represents 25% additional divergence in 6 months. If that rate continues ADASPO, and the COMEX registered inventory data suggests there is no mechanism to stop it, ADASPO. By June 2026, the premium gap could exceed $40. At that point, the paper price becomes essentially ceremonial. Nobody with access to real physical information will sell metal at the paper price. The question is not whether the paper and physical prices converge, they always have. The question is which direction they converge from. Either the paper price rises to meet physical reality, which is what happened in 1979 when silver went from $6 to $50, or the physical market seizes up entirely and the paper price collapses because the contracts backing it are worthless. Both outcomes are catastrophic for paper silver holders. Both outcomes are significant events for physical holders. Yes, Bardak. One positive, one merely survivable. The only version of this story where paper silver holders are fine is the version where the registered COMEX inventory rebuilds to cover the outstanding open interest. Right now, that would require the registered pool to increase by approximately 3,400% from current levels. That metal does not exist in available form. Let me show you the suppression signature one final time, because this is what distinguishes a natural market correction from a constructed trap. In every silver bull market correction that was organic driven by real changes in demand or supply, the lease rate declined as prices fell. Cheaper silver meant easier access to physical. Lease rates are the cost of borrowing real silver. If silver is abundant, lease rates are low. If silver is scarce, lease rates are high. Right now, as the paper price is being managed, silver lease rates are running between 8 and 14%. That is not what an abundant market looks like. In 2019, when silver was at $14 to $18, lease rates were 0, 2 to 0, 4%. Today, with silver at $51, lease rates are 8 to 14%. The paper says the market is normal. The lease rate says the market is in stress. Paper says X. The vault says something different, and in this case, the vault is screaming. This is what controlled outrage looks like, because the retail investor who bought into the 150% silver narrative, who watched the YouTube videos and read the newsletters, and bought the ETF for the paper account, was not wrong about silver. Silver's fundamentals are real. The industrial demand from solar, EVs, and AI infrastructure is real. The supply deficit is real. The East accumulation is real. They were wrong about the vehicle. They were handed paper and told it was metal. They were shown a 150% price chart and told it represented their wealth growing. They were never shown the vault. They were never shown the 356-to-1 ratio. They were never shown the lease rates. They were never told about the midnight reclassification. They were never told that the bank processing their ETF shares is the same bank that built the largest private physical silver stockpile in history. The paper said everything was fine. The vault said something very different, and they were never shown the vault. If you are holding paper silver in any form of Soscio, ETF, unallocated dealer account, futures contract you intend to roll, Aroshu. The time to understand your actual exposure is not when the margin call comes. The time is now while the paper price is still elevated, while premiums are still manageable, while the window between paper and physical has not yet become the canyon it is heading toward. For physical holders, the 150% paper gain is noise. What matters is the premium your physical commands in the real world. Indian buyers are paying 38% over COMEX. Dubai is paying 44% over COMEX. Your physical metal is worth substantially more than the paper price suggests. The paper price going down does not change what someone in Singapore will pay you for a real ounce. Hold your position and do not let the managed paper price move you. For anyone still watching from the sidelines, the accessible physical silver the silver at reasonable premiums from reputable dealers is the inventory most at risk of disappearing first, not because of price, but because of availability. When the premium gap becomes public knowledge, when this story breaks into mainstream finance, the rush to convert paper to physical will overwhelm dealer inventory faster than price adjustments can respond. The Perth Mint suspended wholesale orders. The U.S. Mint repriced Silver Eagles 86% overnight. These are previews, not anomalies. Now let me leave you with the question this entire video has been building toward. Drop a comment right now, Tell me whether you hold paper silver, physical silver, or both. I read every comment, and your answer will shape the next video I make. Share this with one person in your life who is watching their silver ETF and feeling good about the 150% gain. They need to see the vault numbers. Most people will never see this information. The mainstream media will not cover it. But you saw it. Now help someone else see it too. Subscribe to The Hidden Economy. I am going to keep pulling on this thread. The vault reports, the CME filings, the delivery data, so you are never the last to know what the institutions already know. You can join the channel for member-only deep dives, where I go through the actual documents, the actual filings, the actual transfer records. That is where the real evidence is. Screenshot this. Hold me accountable. Save this video and come back in 90 days, because something is coming to a head that has a hard deadline. And that deadline is the June 2026 COMEX Silver Futures delivery window. Right now, the June 2026 open interest represents approximately 180 million paper ounces of silver. The registered vault holds 31, 2 million real ones. June delivery begins in less than 60 days. Either 148 million paper ounces get cash settled instead of physically delivered with no announcement, no headlines, just a quiet, "We're paying you cash instead of metal." Or something breaks publicly in a way that cannot be managed with a midnight vault reclassification. Both outcomes confirm everything you just watched. One happens quietly, one does not. Watch what happens when June hits. This is The Hidden Economy, because the real story is never on the surface.